Hello, my name is Revi Damayanti, from Accounting Class 23A, with NPM 23412007. Here I will explain the material about credit. 1. Definition of credit. Credit is the provision of money or bills that can be equated with money, based on an agreement or contract between the creditor, and the debtor, credit recipient, where the debtor is obliged to repay his debt after a certain period of time with payment of interest or certain compensation. 2. Types of credit. 1. Based on purpose of use. 2. Based on term. 3. Based on collateral, guarantee. 4. Based on source of financing. 5. Based on repayment method. 6. Based on credit form. 3. Credit granting system and procedures. Credit application. Credit analysis. Credit approval. Disbursement of funds. Credit repayment. Monitoring. 4. Interest and credit costs. 1. Definition of credit interest. Interest is a reward paid by the debtor to the creditor for the use of loan funds. Interest can be calculated as a percentage of the amount of credit given. 2. Types of interest. Fixed interest, interest that does not change during the loan period. This provides certainty for the debtor because the installment amount is fixed. Floating interest, interest that can change according to changes in market interest rates. This can cause the debtor's installments to increase or decrease. 3. Additional credit costs. Administration fee, fee charged for processing credit applications, including fees for document inspection. Provision fee, fee paid up front as a percentage of the approved credit amount. Insurance, fee for insurance premiums that are usually required as a condition to protect collateral or loans. Penalty fee, fee charged if the debtor is late in making installment payments. 4. Impact of interest and credit costs. Interest and credit costs affect the total cost of the loan that must be paid by the debtor. It is important for debtors to understand and compare the interest and fees from various credit offers in order to choose the most profitable one. 5. Benefits and risks of credit. Benefits of credit. Funding for needs. Credit allows debtors to obtain the funds needed to meet urgent needs, such as purchasing a house, vehicle, or educational needs. Supporting business activities. Productive credit provides the capital needed to start or develop a business, which can increase income and create jobs. Improving quality of life. With access to credit, individuals and families can improve their quality of life, such as by having a decent home or a vehicle that supports mobility. Cash flow management. Credit can help individuals and businesses manage cash flow by giving them time to repay loans while still running their day-to-day operations. Building credit history. Using credit wisely and making timely payments can help borrowers build a good credit history, which is essential for obtaining future loans. Credit risk. Default risk. Borrowers may face difficulties in making repayments, which can result in late payments or even default, harming both parties. Impact on credit history. Late or default can damage a borrower's credit history, making it difficult to access future loans and can increase interest rates. Additional costs. Credit often comes with additional costs, such as interest, administration fees, and penalties, which can increase the total financial burden. Collateral risk. If credit is secured by collateral, The borrower risks losing the asset used as collateral if they are unable to meet their obligations. Interest rate changes. For floating rate loans, changes in market interest rates can result in an increase in the installments that the borrower must pay, potentially causing financial hardship.